Now, without any further ado, I'd like to introduce our very special guest today, the legendary George Walker. George Walker is the chairman and chief executive officer of the Neuberger Berman Group. Neuberger Berman has offices in 36 cities across 25 countries with some 2,400 employees and managing over $450 billion in assets. So George certainly has his hands full. And before Neuberger Berman, George was the global head of investment management at Lehman Brothers. And prior to that, he was at Goldman Sachs, where he was a partner and a member of the firm's partnership committee. His civic board service includes the Lincoln Center for the Performing Arts, local initiatives, Support Corporation, the Mayor's Fund to Advance New York City, and the Partnership for New York City. Ladies and gentlemen, it gives me great pleasure to welcome the one and only Mr. George Walker. George, thank you so much for joining us.
Thank you, Mo. I don't deserve any of that introduction, so I'm just know I'm laughing on the inside. Maybe in 20 years, but not now. But thank you.
Anyway, no,
My mother would be proud. I hope she's watching.
So let's begin. I mean, speaking of your mother, let's just begin a little bit with your personal story, and maybe if you could give us a brief overview of your journey, where you grew up, some of your most formative experiences, and how did you get to be sitting here?
I grew up in St. Louis, Missouri, outside of St. Louis, and my dad ran a small brokerage firm, which is the same thing that his dad had done as well, and so was interested in markets at the time, and was working there and elsewhere in high school and in college. I went to Penn, to Wharton for school, where a lot of the best professors and most interesting classes happened to be in finance. And ended up at Goldman Sachs and spent 14 years there. So,
along that journey, I mean, there was obviously some folks that were impactful on you, that were role models, that were mentors. Which come to mind? Which would you consider to be most transformative in terms of their impact on your life?
I mean, I think. I guess I would say that I have been blessed to work for and with a lot of really extraordinary people. Some were my boss's boss's boss. Some were folks I worked closely with. Some were folks who, peers, and others were folks who I just came to really admire, who did interesting stuff, who worked for me. And, I think, I try and take interesting lessons from each of them along the way. I actually have sitting next to me at work, I have a picture of from a dinner of all of the former heads of Goldman, and I leave it there just because they were all radically different. They all had strengths and weaknesses. And for me, it was about picking, the one thing from each guy, and trying to, on my own journey of trying to figure out sort of who I was. So, the folks who were most meaningful to me were obviously ones I worked most closely with. Guy who hired me out of school, Phil Murphy, who's now the governor of New Jersey. Guy named John McNulty, who built asset management, a whole series of individuals. Paul Achleitner, who just stepped down as chairman of Deutsche Bank. But really, I think I benefited tremendously from being at a firm where there were lots of extraordinary folks you could learn from, and you just had to sort of pay attention and pick attributes that you found inspiring or insightful.
And what about your parents? Is there any one unique trait that you could sort of point to and say, yeah, I got this from my parents and it has served me brilliantly over the years?
I don't know. So my dad was incredibly kind. He was just a nice, just a super nice human being, and that I admired. And my mother is super driven, and she's sort of a force of nature. Never had a job, but she could run through brick walls, and so to the extent I inherited any of those attributes, those would be the two defining characteristics for those human beings.
Got it. Okay, so you took us all the way to Goldman, but then subsequently, again, you were at Lehman, and frankly, that Lehman experience that you had front row seats to arguably the most extraordinary time in Lehman's history, or right around the global financial crisis. And of course, Goldman had its own excitements. So when you reflect on those years, what do you regard as the best parts, or maybe even the worst parts of your experiences at Lehman and Goldman?
Goldman for me was fun in that I think I had 13 or 14 different jobs there in different divisions, departments, countries, geographies, and so I just got to learn a tremendous amount. And so it was, I will gladly write checks to my high school and college each year, but I learned a lot more from Goldman Sachs, and they, instead of my paying them money, they actually paid me money, which I appreciate. I was a young, ambitious kid, and was frustrated with my at a moment in time in my Goldman career, and made the inspired decision to leave and go to Lehman Brothers, which ended in disaster shortly thereafter. So by any definition, a horrible decision. Lehman, it's interesting. Lehman was culturally a great place. They were, my kids only know it. I have 4 young kids. My kids know it more from the Bank of Evil or whatever in cartoons, but it was actually the folks who I interacted there with, I admired as human beings. And it was an extraordinary period. They made a couple of really bad decisions with regards to how much leverage to have, how many illiquid assets to have in real estate and leverage loans on the balance sheet. But 99.9% of the people in work and things that were going on there were for good. And then the coming out of Lehman was a searing experience that I'm only now starting to get through the PTSD from. It was a very, very scary time, as I don't know of any other asset manager. Perhaps there is one, but having your parent be plunged into bankruptcy amidst a market meltdown with all the world to see was just incredibly was an incredibly scary period.
Yeah, and it's actually an amazing story. I mean, you say it was a disaster, but at the end of the day, you pulled off this management buyout of Neuberger Berman from a bankrupt estate of Lehman. It's a great story, especially where Neuberger Berman is today. And we're going to get to Neuberger Berman in a minute, but could you just maybe talk a little bit about what enabled you to pull off that management buyout, and any of the most memorable elements or greatest learnings from that period?
We had a great team of folks, and so I was lucky in that. While I really only started at sort of the beginning of 07, end of 06, beginning of 07, so it was a quite short period before the ship hit the iceberg. We put in place. We made good changes to the management team and had a great team. Without that team, we don't make it. It was a franchise that had very, very loyal clients, that had really delivered for clients over time. And if you're a client, right, it wasn't, people think of it as being a short process, but from the onset of bear through market seizing in August of 07, through the bankruptcy in 08, and then we weren't able to close our deal until May of 09. Imagine if you're a private client and all of your assets are at many of our business cards said Lehman Brothers. Getting those clients choosing to stick with us was remarkable. So we obviously lost a bunch, but it took a lot of courage, particularly for folks who were fiduciaries and were managing pension plans for police officers and teachers and nurses, and they did overwhelmingly stand by us. And so we went in with something really solid. We had a great team, and we were super fortunate that this random group of people we happened to work with made bold decisions. So whether it was the SEC keeping the part of the firm out of bankruptcy for another day so we could transfer out tens of thousands of accounts to the bankruptcy judge, who was wise, to the creditor committees, to the counsel for the creditors committees and others. They all, any of, and I could point to 42 different folks, if any of them had approached this differently, there would have been a different outcome.
Yeah.
So we got lucky.
It's I think more than lucky, but it's an amazing story. So just maybe to touch on Neuberger Berman for a minute. Like, obviously we've been investors with you in several opportunities, but for those that don't know Neuberger Berman, could you just share a really quick overview of the firm?
Sure. So we are an asset management firm. It's all we do. We aren't in any other businesses. We manage today about $460 billion, broadly diversified across equities, fixed income, and alternatives, particularly private equity. So relative to most money managers, we're very, very sort of alts heavy. Our primary clients are global institutions, about 70% of our assets, and the remainder roughly divided between global individuals and really US, but a high percentage of US or New York centric high net worth individuals. The firm is owned by 605, soon to be about 650 employees. The ownership is very broadly distributed. So not like many employee-owned companies where one person owns 98 and everybody else owns 2. I've proposed that, but my partners don't think that's a good idea. And the firm has had a terrific run. Our employee retention rates are pretty remarkable. We basically don't lose investors to competitors. Our client retention rates have been terrific. While many of our peers are sort of flattish or negative on flows, we this past year grew at about 12% just from flows. Strong performance. It's been we've had a nice run. Yeah.
So you've had this extraordinary run, and I harken back to the early days where you were just kind of glad to survive. How do you think about success today? How do you measure the success of Neuberger Berman? What's your personal scorecard? What does success mean to you?
Yeah, it's a great question. So my scorecard is the firm scorecard. At the end of the day, I believe that, and while I should be separately evaluated for my strengths and weaknesses and do the 360 reviews and the like, at the end of the day, one of the things I learned from Lehman is, it doesn't matter if you do everything right. If the firm doesn't deliver, the boss is responsible. And so the way we measure it is we have a one pager that I share with all of our employees, and I'm happy to share with others. It starts with investment returns, and specifically, are we outperforming peers? And are we outperforming clients across asset classes? If we don't do that well, we shouldn't exist. And so that's sort of mission one. The second section is just simply looking at clients, client retention rates. Are they sticking with us? And are they entrusting us with more or less of their irreplaceable capital? Right now, you see lots of firms in our industry that are growing because markets are up a bunch, but overwhelmingly clients are withdrawing money. That, in my mind, is not a sound, healthy franchise. And we don't want to be the fastest grower. We want to grow prudently and thoughtfully and sort of reasonably over time. And we've been on the high side of what makes sense there. So, it's funny versus a lot of other firms. I was looking at a competitor stuff today, and all of their stuff in the press is about how fast they're going to grow and how many new assets they're going to acquire. In my mind, that's exactly the wrong way to think about the business and leads to lots of bad decisions, right? It should be, if you focus your time on being great and delivering, the growth sort of takes care of itself. And if you focus it all on growth, you're never gonna get there. We then look at the financial results of the firm, earnings, and we used to have a lot of leverage. Now we have basically, we're under 1x levered, so very little leverage. So that's no longer much of a consideration. We then look at culture, whether that's are people staying, and so the percentage of folks who leave each year. We're looking at employee surveys that we hire a third party to do on sort of engagement and enablement, and are we continuing to drive progress there? We look at our rankings in kind of the big surveys that everybody shows up for, like P&I best places to work, where we've done well. We look at our diversity, equity, and inclusion is a key metric there. Do we look like the college educated North American population from which we draw? And if not, how do we close that gap? And then do all people at the firm feel included, or can race or gender or explain lower scores in any one of a series of aspects that we measure, in which case we work hard to eliminate that. And then we look at innovation, where at the end of the day, 98% of what we're doing is heads down and just trying to deliver alpha each year. But in a changing world, we try and find a few clever things to do to try and make money for our clients, given changes that we see in markets and the like. And so we have a pace of innovation that we're comfortable with, which can be either bringing on new teams to the platform. We used to try and bring on sort of 3 new ones a year. We now try and bring on just 1. There's sort of no need to do more. And we look at the percentage of the firm's revenues from new capabilities that we've created in the past 5 years. So that's okay. Longer-winded answer to your question, but that's sort of our scorecard and our North Star.
Okay, there's a lot to unpack here, and I'm going to get to innovation. I'm going to get to how your retention and so many other things. But I want to touch on one thing before I go there. Yeah, you mentioned some competitors, and certainly not sort of meeting expectations or targeting the wrong things or what have you. Can you think of asset managers or competitors that you admire, and what are you learning from them, or what are maybe even some trends that you're trying to follow based on some of these competitors that you're admiring?
Yeah. People usually ask the question, like, which of the big guys are we trying to catch? And I usually answer saying, we're not. Stop. We're not trying to catch anybody. Like, let's just let's just do our job, and we're not going public, we're not selling the firm, like don't lose sight. There are bigger firms than we are that I admire. I admire BlackRock's business model. It's almost a totally different business than ours. There's little, BlackRock to me looks like a country, not a company. I'd say if you wanted to pick a bigger firm than us that we admire, I'd say it'd be Wellington, probably in Boston, in terms of the quality of their people, the quality of their returns. Frankly, I think our job is a little easier, just given that we're a third their size. And I'd say the firms that many of the firms that I admire most are firms that are smaller than we are, often much smaller, that have that deliver for clients, have really special cultures, have extraordinarily high alignment with their clients, where folks are fired up to go to work. My wife works at a little boutique in New York City that's an awesome firm that I admire tremendously. So I think that people make the mistake of of equating size and quality, and I'm not sure, for good or for bad, that's right. I think they're different.
Right. I got to make sure Prime Quadrant gets on your list of.
Absolutely.
Yeah.
You've done an amazing job.
So you mentioned innovation earlier. Could you share maybe one or two examples of innovations that stand out for you, or perhaps a couple of the things that you've recently done that's been innovative and others would regard as so?
Yeah, I think the biggest thing that we've done, historically, that folks are probably aware of, was the creation of the Dial business, where we saw an opportunity looking at alternative firms and saying, you know what, these are real companies, and there's real enterprise value there, and they have a real problem, which is if you and I, set up a private equity firm together and I want to go to the beach, there's not a great mechanism in place to enable that to happen in a way that I feel good about and you feel good about, and most importantly, the next generation who's going to step into my shoes feels good about. Going public comes with a whole host of challenges, as you'll hear from Steve Schwartzman or others who have gone down that path. And so we saw a real opportunity there, and built a terrific franchise in Dial, which we recently contributed to a firm called Owl Rock, and created a new company called Blue Owl, that I think will be one of the world's more important alternatives firms. So that, at least in terms of size, has been one of the more innovative things that we've done, and it's all grounded again in just many of your clients have invested in terrific returns. I can give you 10 examples of other things we're working on right now. A lot on, and we're not alone in this, on sort of custom indexing. So we work, privileged to work with some of your clients in building tax efficient portfolios. It just doesn't make sense for wealthy individuals to commingle marketable securities portfolios unless it's in places like India, or which are more challenging. And so the ability to build, even if you're just going to index it and then loss harvest, assuming a reasonable time horizon, there's an awful lot of value that one can receive. We're trying to ask the next series of questions, which is, okay, can we assemble something that's better than an index fund, that's a better sort of long-term hold for clients at one end of the spectrum? So that would be in the very core space. To we're doing very niche-y things, such as we're partnering with an Ivy League endowment in they're funding us to essentially write short-term puts on crypto. With vol where it is now, you can get paid about 12% a month to take at the money risk in crypto, which if you had done it starting a couple months ago, would, you've lost money so far, but given these quite extraordinary vols, you have to believe it's not going to go to zero, or this is a terrible strategy. And if you're convinced it's going to go to, the price of Bitcoin is going to go to 1 million, then you're far better off, owning the coin. But for many of us who think it's real, but don't quite know how to value exactly where it's going to end up, this is an opportunity to get paid a reasonable amount in an asset that is somewhat uncorrelated to the primary risks in folks' portfolio. So that's an example. I can give you lots of other examples, some of which you're aware of in specialty lending, for example, a whole series of interesting things we're doing in the alternative space.
And so in that spirit, are there any unique strategies that you have a high degree of conviction in, or a high degree of curiosity in, that are sort of emerging in the near term? Not ones you've already participated in, but those that are emerging. Anything that comes to mind?
Yeah, there are lots of things I'm curious about, and there are lots of strategies from competitors that are going to make money and deliver for clients. We don't need to do everything. We don't need to do most things. We just need to do whatever we do really, really well, because at the end of the day, there's only space for so many. So we have to be convinced that the opportunity is significant and real, and that clients are going to make money, and that we bring some sort of edge to bear. So in options, we're early, and we have a world-class options team that's running similar strategies for great big institutional investors in more traditional spaces. In Dial, we were early. In other cases, it's leveraging off of the fact that we sit on about 200 LPACs for private equity firms, and so have unique relationships in that ecosystem that enable us to see things and to get access for clients to things that others can't. But yeah, so we don't. There are 57 great strategies that we don't have that make a lot of money, and that's great.
So maybe I could ask the question a slightly different way, and just in terms of when you're thinking about trends, or reading the tea leaves of markets, seeing where the puck is moving. How do you think about that, if at all, in the context of your role or the firm more broadly?
Yeah, I don't. For me, it's less about that, to tell you the truth. It's more. It's taking a longer term point of view. So it's not putting. These are capabilities we want to sort of stand the test of time, and so while we're being opportunistic, it's not in light of a directional change in markets. There are really easy ways to reflect that view without hiring a team and staffing it and working with clients, and so in my mind, it's about building strategies that you think are great, and then working like heck to improve them, as opposed to, I don't spend any time, for example, on budgeting sales by products or whatever. It doesn't. One is, I'm really bad at it, and having done this for a long time, I've discovered I'm lousy at predicting, because you have to know what markets are going to do, you have to know what competitors are going to do, you have to know what and how they're going to perform. It's just too many variables. And so
how do you prioritize?
At the end of the day, just do sensible stuff. that you're proud of, and work like heck to make it better, and then kind of let the chips fall where they may, would be
Right.
my philosophy.
And so maybe a good indication of that would be if I could ask you how your own personal capital is allocated. Like if somebody had a sneak peek at your portfolio, what would
Sure.
they see from an asset allocation point of view? What would they see? And maybe even if you were restarting your portfolio today, like if it was all cash, like what would the asset allocation look like? I'd love to hear your thoughts on that.
Yeah, so my portfolio has 3 parts in it. Part one is sort of super illiquid Neuberger and Blue Owl equity, so that are linked to my job, and then of the remainder, it's almost divided 50-50 between public and private markets. Very little fixed income, other than in my foundation or IRA or others, where I try and put in as many tax inefficient strategies as possible, and try and get some diversification there. But it is it's all equities, and with a huge dose of illiquid equities, which is not a portfolio strategy I would recommend to anyone, but it makes sense for me. You know, we live pretty modestly. If markets go up or go down, you know, it's fine. At the end of the day, we're going to give, you know, the vast bulk of this away, and taking a long-term view, I believe, you know, those are places where I can earn attractive rates of return over time. And so if I were starting over, it would say if I have a frustration, my frustration is in finding more. I'd love to find less correlated investments that have a, call it, you know, 5, 6, 7% plus expected rate of return. Because if you were to do a risk decomposition on my portfolio, there's just a lot of equity beta in it, in 57 flavors, and a lot of small cap relative to large cap. But it's worked well for me.
Right. No, I can see that. And so, and yeah, maybe I'll help you with that. But anyway, on the just in terms of the broader issues that are either should be front of mind for investors today, or where do you think investors should be focused on? I mean, especially given the wobbly markets we've seen of late, do you see a correction looming? How are you thinking about markets broadly today?
Yeah, so I'd say a lot of the press is still very, very focused on COVID. In my mind, we're sort of beyond that, not entirely, but almost. And if you were in New York City today, I haven't worn a mask yet today, and have been in 3 different buildings. The rates of the infection rates are the test positive rates are bouncing around between mid-1, and we've had a couple of days that it's less than 1%. We've had all of our folks back in the office for a while, and so I think we're going to see the reopening trade there is, I think, where folks should be more focused. And then obviously enormous focus on the Ukraine, which I think is incredibly important in terms of the world we leave our kids. But I think it's less important for investors than forming a view around inflation and rates and earnings. You know, I think inflation is a far greater risk to your clients' portfolios than the situation in the Ukraine is. Okay. In general, I mean, listen, nothing's cheap. It's what happens after years of free money. I don't think so. Another 10% correction from here, even 20% correction wouldn't surprise me. But if you were at, put a gun to my head and said, is the market 12 months from now or less higher or lower than it is today, I would guess it's going to be higher. I think rates are still going to be, I think we'll see some easing in inflation in the months ahead, perhaps not as much as implied by markets, where you see these long-term break-evens and tips in the 2.25, 2.5. I would guess I'll take the over on those, but still well down from the hot prints that we are seeing now. And if you look at earnings, Q4 annualized earnings, for example, on the S&P, I think we're now looking at numbers like 220 with most of the companies reporting. So that implies we're already less than a 20 PE, which for an economy that's really humming, and where I do think, while we're all very focused on the bad news, the COVID and the Ukraine and a whole series of other things, there are a lot of really strong tailwinds. So I in the intermediate term would be comfortable holding risk assets. I think the big issue for private clients, right, is twofold. Just making the big mistakes that I see people make over time always end up being, one, sort of lack of diversification, and two, taking more risk than they're able to hold through the cycle. So it pains me when clients de-risk portfolios in a drawdown and miss the recovery, because that money is lost for forever. And so I think folks making sure that they're wherever they are, that they're able to hold that through a cycle is incredibly important.
Yeah, I mean, I want to come back. I mean, you touched on some geopolitical things, and I'm not sure if it comes across, but I just don't want our listeners to miss the uniqueness of your perspective. I mean, you have one of the few truly global asset managers, and in fact, maybe you could even touch on one of the things. You were I believe, one of the first, if not the third, of the foreign firms that were invited to get a license to build an asset management business in China, right? Am I correct in that?
Yeah, three. We were the third. We haven't gotten our license yet. You have to be invited, and we've been the third firm that has been invited. So BlackRock, Fidelity, and us, and so we're there's then about a 6-month application process that we're nearing the completion of.
So, I mean, I guess, first of all, fascinating. And that opportunity is obviously massive. Like, what are some of the interesting challenges and risks associated with this opportunity with China? And then maybe even more broadly, what are opportunities, risks, learnings have you encountered being a truly global leader in the world of asset management?
I mean, China's interesting, right? So it's a huge market and a huge opportunity, in a market that's been largely closed to non-Chinese competitors. So they are now opening it, not really as an accommodation to us, but more because I think they really want to have a handful of firms who will up the game for their own domestic competitors. So I have no dreams that we will ever be a dominant firm in China, but I think we can bring global best practices, do a good job, and make their domestic competitors do frankly up their game, which is really why from a Chinese perspective, they're willing to they're now opening the markets, in addition to the pressure that Western governments have placed on them to open the markets. So for us, we'll be managing Chinese assets for Chinese individuals. And if my mother still doesn't know what Neuberger Berman is, given our primarily institutional focus, I promise you, the man on the street in China does not know who Neuberger Berman is. So we have all of the challenges of, in effect, building leveraging off of all of our know-how, but building a startup to manage domestic assets for domestic investors in a really tricky market. But we're excited about it, and we happen to have invested a lot in China over time, helping take a number of Canadian institutions there in the equity space, and it's been a market that we've found rewarding. The biggest, so all of those are all kind of straightforward challenges. The big challenge is the Western China, the relationship between China and particularly the US, and how that all plays out. If you were to ask US members of Congress who can agree on absolutely nothing, the only thing they can agree on is, China is bad, and that sells well politically in the US right now. And so US efforts to impede engagement there are possible. So predicting, particularly if the countries, as they're doing sort of tit for tat retaliation, that it's just very hard to plan around or model from. That having been said, every member of the US government is encouraging us to invest and grow there. Members of this is one of these things that should be good for everybody. But the giants are playing above us, and our efforts may be for naught if the wrong legislative package were to emerge.
Well, I mean, you bring up an interesting other consideration I haven't thought much about, but are there regulatory changes globally that are coming to the fore that will impact investors in ways most investors are not aware of?
A lot. Yeah, I think the biggest, so I think you're going to see a very aggressive SEC over the course of the next few years. Chair Gensler, who I happen to tangentially work with in a prior life, is super smart and super aggressive. And so it'll be a very different regulatory environment for us, for good or for bad. All of the ESG legislation that's happening, particularly in Europe, I think is really important. And some of it I worry is quite counterproductive. So we've been able to look clients in the eye and say, we've been, one of the leaders on the ESG front, look them in the eye and say, this will not compromise your returns. In fact, if you look at it historically, we've been able to earn more for clients in mandates that have been ESG led. Is Europe is going down a path and creating Article 8 and particularly Article 9, that may change, where now instead of it being about inclusion and change, it is de facto sort of divestment. And so today, as we have clients pushing us, saying, oh, we want a high yield fund or a high yield strategy in Europe that performs just as well as your core strategy, and we'd like it to be Article 9. It's just very hard. It's very hard for us because there is a real yield give up, and that at the end of the day is return in that space. And so it's going to muddy the waters significantly, I think. But if you actually read the legislation, it doesn't talk about investors or fiduciary or protecting investors. It says, to comply with our commitments at the Paris Climate Accord, we will divert X amount of capital into this space, and as a result of that, we're creating this new regulatory regime. And so I think clients being aware of, is this a portfolio with restrictions? Is it what are you really trying to accomplish? I think is going to be is going to be important. And there are a lot of other exciting things happening. This new standards code that's happening in Japan, I think, is a really big deal, where you're gonna start to see companies that have weak practices, particularly around governance and ESG, getting kicked out of the prime part of the market. I think, Japan is going to have a sort of second Abe-like wave, where we're going to see real improvement in Japanese corporates that I think is going to be quite positive. So there are good things and bad things happening. And I think a lot of the ESG regulatory stuff is good if it's like truth in advertising,
Right.
or help. That's like, the more transparency, the better. It's as it becomes a bit more prescriptive. I tend to view this as, we have to make the world a better place for our kids, and so how do we improve companies? And so what I would love to see is, if you happen to look at it in the US and Canada, companies that have improved their practices on key ESG metrics have delivered more for their shareholders. If you look at it in Europe, it's a little different, given the regulatory environment, where they're almost dividing the world between investable and non-investable. And so if you start off in the investable bucket, you've done well given the flow of funds. And if you're in the non-investable bucket, it's hard. And I'm just not sure that's going to lead to the same rate of progress as it's not what I would have picked.
Yeah, no, and I know this is an area that's very close to your heart. I know this is actually sort of central to the firm. I don't think, people on the call know that Neuberger Berman is one of the 3 North American firms picked by the UNPRI and is a global leader in ESG. And that, frankly, I was actually surprised when I looked through the history of Neuberger Berman that ESG screens were being employed like as early as the 1940s, when like nobody paid attention to it. It wasn't even
called ESG then, but yes, absolutely.
Right, exactly. Negative screens, whatever they were called. But could you give me an example of something unique that you guys are doing today that you think others should be emulating?
Yeah. So if it's something unique, I would say, well, first I'd say, before something unique, I just say the amount of effort that it takes to do this right is extraordinary, and is the source of, a large amount of my time right now, figuring out how to get the data, how to change. Everybody's job is changing at our firm to more effectively address ESG challenges. In terms of something we're doing that's unique, I would say we have something called NB Votes, which is where we are pre-announcing proxy votes before, hopefully well before meetings. So we kicked it off last year with Berkshire Hathaway, in a spirit of being a little provocative, to pick a management team we adore and a company stock that we've owned forever. And we said, listen, we love you guys. We've written you a bunch of letters. Your CEO's age starts with a 9. His principal advisor is approaching triple digits. You don't have a named successor. You don't have a lead external director. Like, this is bad governance. Like, so we're going to vote against all your directors. And we said it publicly, they shrugged their shoulders. We were thrilled that they actually appointed a named successor. And so we're doing that. We did it the first year, we did it 30 times. Last year, we did it 60 times. This year, I would guess we'll do it 100 times. Tend to be about half in favor of management and about half opposed. But even when we're in favor, we're trying to be provocative and frankly call balls and strikes. So I can give you an example. We came out against we've done it a couple of times now. We did it with Cigna and we did it with Amex, against a big gender and race pay equity audit, where we felt like those 2 firms had done a quite good job and were making real progress. And that this same proposal that was shipped to many other firms where we supported it, that the industry leaders in doing a better job for their folks should, for the time being, be excused for that exercise. So we're trying to behave like owners as opposed to just holders of securities. And I wish somebody told me the other day that a big firm, not Wellington, but a similar size firm that I admire tremendously, is looking at starting to do the same. And I think it would be great. I think, frankly, that's what if we can get more of that covered on the financial news, we can make companies better as we as owners hold them accountable.
And so, I mean, there's a lot of risk you've talked about, and so diversity, inclusion, governance. When you think about the kind of the aggregate of long-term risks, which ones would weigh heaviest on you? Which one are you most concerned about? Maybe you mentioned earlier, you're thinking about this from the point of view of the world your grandkids will inherit. Again, in that context, which are you is keeping you up most at night?
I'd say the risk that keeps me up most at night, unrelated to sort of my day job, and one that I can't figure out a way to influence in a thoughtful way, is just the real struggle that our democracies are having around the world. Nowhere more than in the U.S. In terms of this extraordinary polarization and populism that exists, and leaders' total inability to deal with important sort of long-term challenges. And so our brains aren't hardwired. We haven't yet figured out how to deal with social media, and it's a huge issue. You see it in our democracies. You also see it. I'm been interested in looking at, for example, the impact of it looks like it's particularly Instagram on teen girls. Is really tough, and when you look at self-harm incidents and reports of depression, and look at it over long periods of time, and look at the spike that starts right around the introduction of the like and the retweet feature, it's pretty scary. And I think we'll figure that out in 3, 4, 5 years when there's more data and more work. We haven't done that yet. I think it's wreaking similar harm, combination of social media and the proliferation of, we each get our own news sources that simply reinforce our existing views. Democracy is being challenged in a way that scares me for our kids.
Yeah, been relegated to the echo chambers. I get it. I want to come back, Georgia, before we leave. There's a couple of things that I just want to touch on. You mentioned earlier a little bit about your focus on the team, and I've obviously been following Neuberger Berman as kind of, I believe, been ranked first or second in best places to work in the industry for years and years in a row. I think currently number one. Maybe you could talk a little bit about what's your secret sauce, particularly in this labor market, and if you were advising other firms to follow your lead, what would you recommend they do?
Yeah, we've been thrilled. We've been first or second each of the last 8 years. I'd say there are a couple of things. One is you've got to decide it's a real priority. So earlier we started the conversation, you said, what's your scorecard? Right, that's there. That's every bit is there as our financial results, or anything you would expect to be there. So one, you make it a priority. Two, for me, the single thing that's been most helpful has been, we use Mercer, but there are others who do it, employee surveys, these anonymous surveys, which I'm obsessed with, because they, well, I don't know the individuals involved. It helps me point to issues in different parts of our firm. So learn that one of our fixed income teams, for example, the firm scores very hard on, I can say anything to my boss. I can challenge my boss without fear. And firm scoring 198, 198, one group 27. Like, okay, I know I got a problem, and so I can go fix it. Or I feel like I can have a balanced life outside of work. Our numbers are really high, other than in one particular geography. Okay, I got to get on a plane and go and fix it. So I think making it a priority, measuring, getting the data. Back to our data science comment, same is true in managing the firm as in managing portfolios. Getting unique data that is actionable is incredibly important. And third, I just, be honest that having a structure in place that if a client pays us and one of our competitors that say is publicly traded, where maybe leave aside the senior guy, maybe the broad troops own 5% of the equity or something, they will probably, of the revenues that are paid, something like at the end of the day, high 30s cents on the dollar will find their way into employees' pockets and new investment in the firm. For us, that number is more than 2x that. And so as a manager, which is, why private employee-owned firms tend to thrive, it's not because I'm a good manager. It's because we have twice as many dollars to reinvest in the business and to compensate people, and that's just in a longer term sense. Firms that are that don't have that structure are in a marathon race with us, and they're carrying two big rocks in their backpack. So it doesn't mean we'll always win, but if we can work twice as hard and have twice as many resources, you only have to we only have to be a quarter as smart
Right.
to beat them. And I feel like sometimes I'm a quarter as smart.
Okay. We only have like 3 minutes. I have 30 questions. So I'm going to try to do a laser round, and let's see how many of these we could kind of get in, because I haven't gotten to half the questions I want to ask you. Okay. So first thing that comes to mind, advice that you would have for other family offices or private investors. Would be common mistakes that you see.
Do you want one word answers, or
okay.
I think pick great partners like Mo, and diversify thoughtfully.
Okay, well, I gotta pay you for these. Okay, if there was only one thing you could communicate to your great grandkids who you will never know, what would it be?
It's funny. So my dad passed away at the beginning of COVID, not from COVID, and he had been working on a sort of a history of our family that he handed over to me in near finished version. And so I've been reading that and thinking a lot about it. I think honestly that was a nice guy and a good person. Because it's at the end, I love my family and tried to be a force for good. And if people think that, then I'm happy.
Fantastic. Okay, types of things that you do to unplug, or something somebody would find surprising about you.
Same answer. I've become obsessed with tennis. I never played until about 5-6 years ago. And it's great fun. I played a lot of golf as a kid, and I'll never be as good a golfer as I was when I was 14. And so it frustrates me. I'm a horrible tennis player, and I'm getting better, and it's exhilarating. So it would surprise people because I weigh too much, so they wouldn't believe that I play tennis. But that is my happy time.
Okay, last question. So you built one of the more extraordinary firms in the world. Or help build it to the level it is at today. What still sits on your bucket list? What do you still hope to achieve?
I'd like to see have the firm be great 20 years after I'm gone. That matters to me. I want my kids to be happy, engaged, productive folks, and I'd love to do something that is more directly service linked. So at some point when I'm done with this, just, finding a way to give back to a world and to others who've given me so much would be that's really important to me.
George, that was fantastic. I can't thank you enough for joining us today, for sharing your incredible insights with us, and being so generous with your time and wisdom. We greatly appreciate it and hope we could do it again soon.
Thank you, Mo. I'm flattered to be included, and super grateful for the partnership with Prime Quadrant. And if there's anything at all we can do to be helpful on any front, we're proud to be of service to you, and eager to be helpful. Thank you.
Thank you. Thank you. And for all of our participants, thank you for joining us. If you haven't yet donated, please do so at the Lunches with Legends site so we continue to strengthen pediatric mental health in our communities. To George and everyone on the call, thank you for your support and wishing each of you a wonderful day. Thanks so much.
Thank you.